YouTube, what's up? It's your boy Kobi back with another video. 4 stocks, we're gonna get right into it. Let's do it. Stock number 1, Viacom CBS, ticker symbol VIAC. So everyone and their grandma is talking about Viacom at the moment, and rightfully so. After the stock run up over the last few months, reality struck in a major way when Bill Huang of Archegos Capital was forced to unwind his huge Viacom position after a surprise share offering by management. The combination of these two factors helped drive down the stock over 55% in 3 days, and at the recording of this video, the stock now sits at about $42 a share. Full disclosure, I bought Viacom stock at $23 a share, thinking the market had significantly discounted its opportunities in the future. So as a result, I was awarded the beautiful reward watching my investment go from $100 to $45 in real time. Wiping my tears to the side, however, now that we know the cause of the dramatic drop, it's definitely time to ask the question if the sell-off was overdone. First things first, how does Viacom CBS make money? 4 segments: advertising, affiliate, which is just the subscription fees they get for cable and streaming, content licensing, and theatrical. Guys, I really can't understate how much content this company has. It is completely overwhelming. We all know MTV, BET, Nickelodeon, Comedy Central, and of course the CBS programming, but let's not forget about Paramount Pictures and their premium network Showtime. In addition to all of this, as a huge sports fan, they also share the rights of the NFL, PGA Tour, UEFA Champions League, NCAA Tournament, and the US Open for tennis. Beautiful stuff. At a $28 billion market cap right now, trading at a price to earnings multiple of 12, it's no longer the screaming buy it was at a 5 PE back in the summer, but I think there is still some value here compared to other legacy TV companies. The biggest challenge with Viacom is going to be fighting the deceleration of their TV advertising business while trying to recoup some of that attrition with streaming. Now don't get me wrong, there's a ton of competition with Netflix, Disney, Hulu, and so many others, but Viacom has so much content, I think they can carve a piece of the pie with the right marketing. CBS All Access was a bust, and it annoyed the crap out of me that they made you try to sign up to stream for the NFL playoffs of all things. But the rebrand of their streaming to Paramount Plus perked the ears of investors that are now like, wait a minute, there might be something here after all. It's definitely going to be a bumpy ride with more short-term traders moving in on this with all the recent volatility, but a $42 share price offers a lot of upside from the latest $100 high. And guys, come on, they own SpongeBob, which obviously is the most important reason to invest. Because you know what's funnier than 24?
25.
Stock number 2, Alphabet, ticker symbol GOOG. As someone who never likes to routinely buy at all-time highs, I have to swallow my pride and make the exception for Google. I know some of you guys are going to say, Kobi, come on, really? You're recommending Google of all companies after they've just run up 10% in the last couple of weeks? Just give me a second to explain why you shouldn't make the same mistake that I did. So I actually wanted to get into Google last year. I had my eye on it for a good minute, was waiting for a good entry price, and I just always thought, you know what, it's just a tad bit too expensive. So I waited, Q3 2020, boom, blowout quarter. Google is up 10%. I was like, damn, all right, I'll wait. I'll see if there's gonna be a pullback. The market's been a little bit sketch. I wait till Q4, boom, blowout quarter after Q4 2020, shares up another 10%. So I say, oh my goodness, Google's probably gone too far. This market's so hot, S&P's at an all-time high. Let me just wait and see if there's another pullback. I wait, these past 2 weeks, Google up another 10%. So I'm done with holding out on Google. I'm getting in now at $22.50, and I'm not doing this out of emotion. Let me explain as to why. Valuation-wise, although the company trades at a 37 PE ratio, their EV over EBITDA remains modest among its big tech peers, and I'm super bullish on some of the developments they have going on. Ad revenues sizzled last quarter, YouTube growth was up over 40% quarter over quarter, and the cloud business is ramping up in a scary way. Speaking of their cloud business, revenues increased upwards of 47% year over year, but they actually lost $5.5 billion in 2020 overall from this endeavor. But here's the craziest thing, and where my inner dialogue convinced me to get in. Despite that massive loss, free cash flow for Google was up 38% year over year from 2019, which absolutely destroys in comparison to Apple, Facebook, Microsoft, and Amazon. You show me another company that can lose $5.5 billion on one of their major bets and deliver that level of significant free cash flow growth in the same year. So guys, consider what I'm about to say next, the pep talk. The balance sheet is amazing, very little debt. If you're not yet in this company, it may be time to get in. When you talk about a company like Google, this is a forever investment. No cap, I'm hoping to hold this through my grave, my kids' grave. Hell, my grandkids' kids will probably be shareholders of Google because they are the type of company that can remain at the forefront of tech and innovation for an incredibly long time. You can't worry about the price on the margins because in the next 10 years, I would be very shocked if this company does not outpace the S&P 500, and at the end of the day, that's the name of the game when investing in individual stocks for the long term. The only thing that I can see that can get in the way of this stock slowing down is an overall market slump, but even then, the most resilient equities are most likely going to remain the ones with significant cash flow, and that is exactly what Google is. By the way guys, don't have any shame in purchasing fractional shares. Google currently trades at $22.50, which is quite a lot of money. If all you can afford is to invest $100, don't let it stop you from putting money into companies that you want to invest in. Percentages is all that matters. Stock number 3, Magellan Midstream Partners, ticker symbol MMP. So I'm out here filling up my tank and I realize gas is at ridiculous prices. In midst of the reopening where the world is looking to get back to pre-2020, the thought of diving into energy is looking more and more appealing. Now, there are a million ways to get exposure to energy. You can buy XLE, you can get into one of the big oil giant stocks like Exxon or Chevron, or you can even just go and purchase oil futures if you feel you have strong conviction on where the price of oil is going to be in the near future. Problem is, for me, energy plays are always very risky because it's really hard to predict the price even when you have a situation like right now where it feels like oil prices are going to stay elevated for some time. So personally, I need a bit of a sweetener to hop in this market with also having a relatively short-term investment horizon. Enter Magellan Midstream Partners. Trading currently at about $45 a share with a $10 billion market cap, MMP is currently offering a 9% dividend for anyone that is willing to purchase their stock. Hey, wake up. Come on guys. I know we're talking about dividend stocks, but I haven't even gotten to the good parts. Let's talk about Magellan and their business. Magellan Midstream Partners is a midstream company that engages in the transportation, storage, and distribution of refined petroleum products and crude oil. Essentially, think of them as the middleman between the oil producers and the distributors. Now, there is no shortage of midstream companies to choose from, so why did I choose MMP? Number 1, their balance sheet is in better health than larger counterparts like Kinder Morgan. Guys, we gotta be cognizant of the fact oil companies love to dangle dividends in front of us to entice us to invest, but because of oil's volatility, there's always a risk the dividend can be cut at a moment's notice during a downturn. Having said this, Magellan is not a company overly focused on using debt to expand their growth projects as they are with ensuring they are able to pay the dividend. They got through 2020 without a dividend cut, and as someone looking for a pure yield play over the next couple years, that is music to my ears. According to Simply Safe Dividends, MMP's dividend safety score rates a 61, making one of the safest dividend plays for midstream companies out there. Moving on, I actually believe Magellan stock could appreciate from here. Their trailing price to earnings ratio is about 12, which is slightly below their historical average, and also keep in mind that PE ratio references the Q4 earnings where average price of crude oil was about 20% lower than the price today. But let me be clear, this isn't a forever stock for me, nor is it a stock that I expect to double in 2 years. Instead, this is an investment that I think will pretty easily net me double-digit returns over the next couple years, and I'm happy to park some cash here while the reopening heavily favors companies like Magellan. Exclusively high-growth investors might be disappointed, but I have a feeling any yield hunters will enjoy this ride for a few years. Stock number 4, Alibaba, ticker symbol Baba. Before briefly diving into this one, let me just say I'll be making a full video on Alibaba in the near future as it is one of my favorite investments in 2021. At the moment, it is currently one of my largest individual holdings, and at recording of this video, it is currently trading at $225 a share with a market capitalization just above $600 billion. Just in case you don't know, Alibaba is the largest e-commerce company in China and is often compared to Amazon for its reach and influence over China's economy. Taking a look at their financials for a second, 2020 revenue was $71.8 billion and net income was about $20 billion. This constitutes a staggering 28% and 73% growth respectively year over year. At the moment, however, the negative sentiment on this company is immense. In late 2020, the Chinese Communist Party had enough of Jack Ma, Alibaba's founder, and decided it was time to put a stop to his growing influence. After a speech in late October where Ma criticized China's financial regulations on the eve of Ant Group's IPO, a dark cloud moved over Alibaba and its growth prospects as China immediately started to act to rein in the e-commerce giant. The Ant Group IPO was suspended, and then in December, China announced Alibaba would be undergoing an anti-monopoly probe. And as you can see, right after these things went into motion, the stock price plummeted 30% to where it is today. The reason why I remain incredibly bullish on this company is because the valuation has come back down so much that it becomes a question of how much are the fundamentals really impacted by this development. Alibaba has a forward price to earnings ratio of 19, and revenues are projected to grow another 30% in 2021. While there is a threat some of the actions China can take will put pressure on Alibaba's margins, like market regulators fining them $2.8 billion over this past weekend, I have a very hard time believing China will completely bring down its tech darling. Alright guys, a little bit of breaking news today with Alibaba shares going up 10%. So that's the beauty of the stock market. You see a company that has had so much negative sentiment. China regulators fine Alibaba $2.8 billion over the weekend, and then today we find out the market is actually reacting super positively to that. So it just goes to underscore how much this stock has been priced negatively. Now, if you're not into Alibaba yet, my advice would be $245 entry price remains a great opportunity. If you are a long-term investor, I would not hesitate at getting in at $245 because personally, I have no idea if this is going to be the run that moves up Alibaba up back to its all-time highs, or if we're going to continue to trade sideways, it's going to come back down to $220. In very low-key fashion, by the way, Baba grew their cloud business 50% in 2020, and although it's only a small piece of the pie right now, it adds to the thesis that Alibaba's come up could still be at the early stages. At their current stock price, in my most humble opinion, I think Baba is a steal, and it's good to know I'm not the only one. Just recently, Charlie Munger's Daily Journal invested a $40 million stake, and he's just one of many institutional investors that are bullish on Alibaba. Obviously guys, there's so much more to unpack here, but I'll save that for a future video where I'll do a full deep dive on Alibaba and its business, along with every risk, including the most obvious risk of investing in Chinese companies in the first place. For the time being though, because I don't want to leave you guys in suspense, just know I am a huge buyer and will continue to be at these levels. Anyways guys, that is the video. I hope you enjoyed. I hope you gained a little bit of value. Again, these are just 4 stocks that I'm getting into. Please do your own research. I'm not a financial advisor. Let me know in the comments what you think about these stocks, their bull cases, their bear cases. I would love to hear from every one of you. The stock market right now is super hot. It's super interesting. There's so many different plays that people are doing. We'd love to hear any stocks that you guys may be interested in as well. And with that said, I hope you guys have a beautiful day or night, whatever time it is. I'll catch you on the next one. Peace.